Well, welcome everyone. Thank you so much for joining us today for our Budgeting and IT Investing for Law Firms presentation. We are super excited to do this with our friend and colleague Derek Barto, who joins us today. Derek is a law firm financial planning expert and a CPA. He helps lots of law firms like yours achieve financial success through thoughtful planning, expert strategy, and guidance based on his financial and legal industry expertise. So he has this kind of unique legal industry application of these skills that gives him a really keen eye into law firm financial processes, procedures, and best practices. He focuses a lot on securing your firm's financial future and building strong structures for financial success. Anything to add, Derek?
I think that about covers it. Uh,
All right.
yeah, and let me make sure I can move it forward. There we go. So, well, thank you, Jordan, and thank you, Mike. You've been longtime friends, and appreciate you kind of coordinating this and putting it together, so we can highlight some of our common expertise. I've been working with law firms uh, for 15 years, almost 20. And I've seen a lot of budgets. And I've seen some good ones. I've seen some not so good ones. And so this part of the presentation is really to kind of help give some tips and some advice on how to kind of build a better budget. It is not going to be talking about, your rates and hours and how to do that. It's kind of, it, we won't say that's a given. There's nuances to that, and if anybody wants to check out more on that, there's a ton of information and articles on our website that can help with that. But this is really about how to make it more strategic and build a strong budget. So I will jump right into this, and really, there we go. Kind of get into why the budget matters. And we've got varying skill sets on the line here and varying functions. So I'll be a little detailed, and I will say, feel free to jump in if you do have questions or uh, want to have any conversations. I don't mind being interrupted. I don't mind anything, Michael. I think we just went forward one real quick. Um, so anyway, the idea of a budget is really to make it useful. You do not want to just put some numbers in boxes and then see how you do against the numbers. You really want to really make it a tool. And it is really what I've learned over the years. And I started with a small CPA firm where I was working, and we merged into a larger firm. And what I really found is that the budget, ran the year. It is the embodiment of the strategic plan. And in a lot of cases, it is the strategic plan because, your firms may have gone through strategic planning processes that are kind of grand and what we want to do in 5 years and involve a heck of a lot of what I'll call softer stuff. But when it really comes down to it, how you can tell if that will be useful and if it's being executed upon is a really strong budget that reflects that. So that's what we really want to do with this budget. So how do we do that? Well, number one is we start early. We have to make sure that we engage leadership and we're talking about our assumptions and our information ahead of time. And I will tell you, the time is right now. It is not January of next year. If you're starting in January, you're cooked. Are kind of you're already missing the opportunity. One, because your January will pass and you will not have had a plan. Two, is that people are off to the races, so you haven't had a chance to really align people to the budget and the plan and give them a chance to really accomplish what's expected in there. This doesn't have to be as grand as it sounds either. It could be hours goals. It could be raising your rates. Are there any clients we can raise rates on? It doesn't have to be super complex. But starting early and engaging leadership is to knowing what do we want to do this year or next year, and what's it going to look like. That helps us really be thoughtful about our assumptions and not rush into just putting something same as last year, right? And so we need to really be looking at these things and deciding what we're going to do strategically. So starting early is really significant value to a good, solid, well-built budget. The other aspect of a well-built budget is making it measurable. you really have to be able to come back to things and understand, okay, what did we plan versus what happened? And that's kind of making, a live dynamic budget will help do that. And you can't do that if you're budgeting based on certain assumptions and then your accounting is done totally differently, or your partners plan and do something else. So we really need to make sure that we're aligning kind of what we're budgeting with how we're gonna track it, because I've seen that a lot where we budget based on categories and we've grouped categories. Okay, well, what accounts are in this category? What vendors are in this category? Well, I think it's this and this, and then it comes time to compare to the financials, and it's like, well, this is in this category, and on the financials, it's over in this other, expense category, and we can't really match it. So then we can't really use our budget, and it's really it hinders the budget and it makes it worthless. And it's really problematic. And that is why I find that a lot of firms do not use their budget. They go through the process and it's basically a drawn out way of saying, what do we think we're going to make this year and what does our revenue have to be? And then everything else just goes to the wayside. There's no strategy to it because it's not grouped properly. So you really have to be able to measure things and drive expectations. Fixed versus variable costs are important as well. Your rent is obviously fixed. It gets budgeted a certain way. Variable costs are more controllable. It's strategic. You can pivot mid-year. You can make some changes and make significant profits by managing your variable costs versus your variable revenue. So having those separated and identified is a way to make a budget really, really functional and really, really dynamic. So when you're looking at things based on firm size, you kind of have to do things a little differently. And, small firms are going to focus on certain things that they can measure, and large firms are going to have to do things a little differently. Why? Because you have departments, because you have different offices. You may be kind of slicing up the information in different ways that are important to the firm's strategy. So usually with smaller firms, we budget pretty, specifically based on people, and then top vendors. And that could cover 90% of your expenses. And it's, moderately straightforward. There's some complexities to it, but if you can look at all the people that you have, what you expect them to make, what their benefits costs are, what their payroll taxes are, what their, all their specific costs, then some of their overhead, and can attribute that to them directly, then you can compare it to their revenue. And I hear so many firms, they want to know what profitability is. Well, you measure profitability just based on the big numbers, and you're 90% of the way there. The rest is really fluff, and it's really much easier to do and digest. So small firms can really get their arms around this in a planning situation going into, this right now into 2026, and be able to identify what their direct profit will be based on what we expect people to work, what their expenses are, and then we can fold in top vendors. Well, some of those relate to benefits. Okay, great. Maybe you attribute it to the people, maybe you attribute it to the vendor. Either way, we need to be able to look back and say, what were our benefits costs versus what we expected them to. Right now, we should all know our benefits costs are going up. If it's health insurance, they're going up, close to 10% next year. If your benefits costs are 15% higher, you have some digging to do. It's nice to know which vendor it relates to and what costs you're going to try to control as you see these costs start to rise. The other thing you want to look at is major events. If you're putting on marketing events, networking events, retreats, those kinds of things that you can kind of carve out separately. The idea is you want to make sure all these things are comparable to what you're going to track in your accounting system, because when you compare, you need to be able to compare all those things in a really succinct way. The art of this is the organization and setting it up so that you can quickly identify from your accounting records, hey, what was the cost of those major events? Maybe we can tag it in our system a certain way. Maybe we can code it all to a certain account. Maybe we can run a report that shows the account and the vendor, and we can do it that way. There's ways to do this to make it a lot easier to compare, and that's what you need to be thinking about in any size firm. When you get to the large firms, you're really trying to just get kind of the big enough numbers. You're not going to budget your staplers in any environment, but because you have these different dimensions, I'll call them, whether it's offices or practices, you really need to kind of decide what's important. What's going to give you 80% of the value with 20% of the time, and maybe you can get that to 90-10 in an ideal environment. But you have to kind of pick and choose what's going to be important enough in a larger environment. And the critical aspect here in larger firms is really going to be what dimensions you're using, how you're tracking and measuring what your splits are, whether it is a department. Well, how are we going to define departments? Are our departments defined based on our people? Are they defined based on our clients, our matters? How do we bucket things into departments? Because even large firms or larger firms, 100 attorney, 200 attorney firms, some of them cannot get a handle on their departments, and that's okay. It's because you're not defining what they really are. You kind of knee jerk into, okay, well, the people are doing the work, so the people is how we have to define this department. Well, not so much, because the matters may be what drives it. That's what we can control and track. And on intake, we assign these matters to certain practice areas. Wouldn't that be better? And then how we attribute the costs to that matter is a little bit of a different exercise. And that's where it gets a little more complex for larger firms, but it's very attainable. And especially if you're focusing on how do we push 80 or 90% of the information into the right bucket, and then spread the 10 based on a reasonable allocation methodology. Well, that 10% or that remaining 20% is usually responsible for 80% of the effort. So if you can figure out how to deal with that, you can scale and measure things a lot more easily and make your budget a lot more valuable. So the other aspect here that you need to think about when you're trying to make your budget measurable is the groupings that you're going to use. And this is kind of a cross between your financial reporting and your budgeting, because I will tell you from experience that attorneys don't care about the same things accountants do. And they don't care about the same things that operations folks will care about. They want to many times just give me the high level. Tell me what to do. Give me bite-sized, actionable advice of what to do with this. Because when you give an attorney, and I'm generalizing, of course, but you might give an attorney a list of things and they will then assume that they are deposing you. And they will look at each little thing and it'll get into, is this correct? And why is this vendor's name spelled wrong? And this is duplicated on here and this is out of alignment. This is all wrong. So you get into that trap where if you have your groupings at a high enough level, you can say, this is what's going on. Your benefits, the example I was using before, are way over budget. We've gone through and we've looked at these and we can tell that we are offering way out of market benefits for X, Y, and Z. We need to correct this. Okay, how do we correct it? Well, here's the options. Great. Let's do, let me look into it. Let's do option A or whatever it is, but you're then guiding a conversation with keeping them out of the weeds. And that's what you want to do. That's what you want to do to make this actionable. That's what you want to do to engage people and get them really focusing on kind of what they can do that's important. They're not behind the scenes in this budget process. You as the finance or operations team, you're really controlling this and you're kind of telling them, here's what the problem is, here's what I need you to do because you have control of this. So, and that's what we'll talk about in a minute is, how do we engage the right people? How do we really make this actionable when we are getting this information and we've got it measurable, we've got our groupings right, and then we get kind of the right information. How do we get it to the right people? But before we get into that, well, the groupings matter for what I just discussed, and just cleaner variance, simplified reporting, and accelerates the learning loop. You can kind of identify what pops out pretty easily and know, again, 80-20 rule on your efforts. Where should I focus my time? Well, geez, I might be able to save hundreds of $1,000s on, if I focus on benefits. If I look at office expenses, there might be a few $1,000s in there. I'm focusing on benefits. Let's get the biggest bang for our buck. Those accounts that aren't as clean, right? How do we handle those? And this is really a bit of a learning loop where you've got to go into these accounts with our client cost advance. It's a little more of a cash flow budgeting because it goes out and it comes back in. How do we handle something like that? Well, there's a lot of different answers to that question. I can have give some advice on that here, but I'll skip that and more exemplify the process um, to kind of to isolate those, right? We need to kind of look at these things. The other thing is contingency accounts, referral fees, credit card charges, these kinds of things that like, oh, we can't tell if a client's going to pay by credit card or not, so we can't budget what those fees will be. Well, then we need to separate them. We really need to look at them as kind of our flagged, isolated, problem accounts. And we need to start to find a way to get a handle on that. Because I'll tell you, with credit cards, that's a big number. And I've worked with clients on these credit card fees for years. And for many firms, you've got, law pay is the kind of the gold standard. They know how to follow all the rules. And it's like, oh, the price they charge is market. Well, not always, right? So by isolating these and kind of understanding that we don't have control over them, well, geez, now we need to really bring them down because we need to shrink the expenses over which we have little control. And so by identifying those accounts and separating them out into different buckets and budgeting them a little bit differently, and really raising the red flag, we can kind of turn them into either kind of less impactful accounts or really stable accounts. And so we do that through iterations. We do that through separation, isolating them, going through them separately, and learning more specifically as to how they behave and what they interrelate with. Obviously, credit card fees will relate to revenue in the door, but what else can we tie them to? What types of clients do they relate to? How do we manage them differently, and how do we impact the ability for our clients to use credit cards? Well, okay, well, maybe we charge a fee for it. Do we want to slow down payments like that? Well, let's look at it. Let's look at our AR. Let's look at our receivables. What's the value of having that credit card option and us paying for it versus the speed of collections that we associate with it? So when it's separate, you're able to look at different things, and not kind of bucket them in with the rest of the easier stuff. And again, it's going to be that 80-20 rule. So you just have to keep doing this when you're looking at these problem accounts. If you say they're too hard to budget, we're not going to be able to. We're just going to take a wild guess and include it with the rest of the budget. That's not effective. That's not productive. That doesn't give you the ability to learn. So you really have to look at the past, continue to iterate and model and adjust. And that's it. And one of my favorite quotes is the more I practice, the luckier I get. And you just put yourself in a position to kind of get it right. And if you're not trying new things, the same old thing is just going to happen. So you're not going to be able to get it. But these problem accounts, they're not unique to your firm. They're not unique to any firm. Every firm has trouble budgeting certain accounts. If you just punt, you're never going to stop punting. Okay, this is what I was talking about before when it relates to measurement. Who's our person, right? When we have problems, are we going to the managing partner? Usually, smaller firms are going to be at the managing partner level, and maybe there's some department heads or an executive committee that you'll be able to talk to. But which person am I talking to when this budget pops out some information that I need to communicate? And if I identify certain cost savings, or if something's over budget and there's a problem, who am I raising the red flag to? And these are the things that you want to think about ahead of time in planning. Who owns this portion of the budget? And when you get into larger firms, you're really talking about department heads. You're talking about practice leads and those people who really own this stuff. And if they're not owning it, they probably don't know what they own. And so making that a little more clear and kind of tying what they're doing and the decisions that they're making to some level of financial performance, whether it impacts their compensation specifically, it should, their department performance, if they're going to run an effective department, or if they're going to run a successful practice, they need to run it. And so these kinds of, this kind of engagement and these kinds of attributes in a budget is really important. Kind of being able to carve it out, being able to communicate with those folks who can do something about it, and knowing how it's going to be reported to them, it enables them to be able to do something different and impact the change. If their numbers are so far off where we expected, we need to understand why. Maybe it's a specific client that didn't come through. Great. Well, does that mean we're going to have a lot of capacity coming up in the next few months here? Like, do we need to do something about that capacity? Can we shift it to other practice areas? We need to be able to identify those and be able to have the communication with those who will actually make some changes and the performance will impact. So the next section is kind of when we're done. We've built a good budget so that we've kind of planned for, measurement and using this tool as a way to drive improved profits. I mean, it's really what we're going for here is we are trying to improve the profits of the firm, save money, drive revenue, get better value out of the resources that we have, and do it in a structured way where we have a plan and we can know if we're going off that plan. So now that we've set that up, the next question is, okay, how are we going to learn from it? Right? Well, you got to use it. And I love, when I love in air quotes because there's so much lost value when it's not used. But I love to see, okay, we did a budget, we finished it in January, we barely look at it, and then it comes up in November or even December of like, oh, how'd we do? Like, who cares? Like, we have profits. I mean, the year is over. Like, so however we did is like, what are we going to really be able to do from that? Maybe we can learn from next year. But even then, we're in October, and I'm saying your budget should be done. If it's December, it's like you're really not even going to be able to impact 2026 in this scenario. So really making sure that it's something that gets monitored and talked about regularly. And some of this is culture. I mean, you in the finance department can drive this, you have to kind of be a squeaky wheel to get it to be used because attorneys usually don't know this, right? Some do, some do. And in well-run firms, what I can tell is that attorneys are looking at these numbers. They have a budget, they have a plan, they have expectations, and they want to know how they're doing against those expectations. Right. So you have to compare to prior year. You have to identify root causes of the deviations. When you see them, you have to ask the questions. This is critical thinking. This is, hey, we've set up this tool in a really, a simple way. And, all the things that I just mentioned in the planning phase, like they shouldn't take you forever, right? Part of what you need to do is structure this so that you can get the information quickly. And I will tell you, it's not a fancy budgeting software, even for large firms. Even for large firms, I recommend budgeting in Excel. It is dynamic, and if you use the SharePoint and Microsoft 365 environment, there are tools in there that can help you budget many different departments. You can do roll-ups. You can do 90% of the features that are in some of the larger budgeting softwares that you see firms invest, hundreds of thousands of billions of dollars in. So we set it up day in and day out. Small firms, large firms. This is what we use, and we, as a firm, we're outsourced CFOs for law firms. So we live and die by these budgets. I'm giving you the tips and advice that we use on a day-to-day basis. Like this is how we run our business, and we do it all through Excel and SharePoint. You do not need anything fancy. You just need to be able to identify the causes of the issues, and you need to refine, either the assumptions for next time, or you need to be able to change what you're doing so that you can make more money. It's not about the tool. It's never about the tool. If you are doing it well and find that there are some limitations as to the tools that you're using, enhance it with some technology and investment. But be really sure that you need to, because 9 times out of 10, if you're planning for that investment, or if you pay for that investment and you don't know how you're going to use it, and your process isn't tight and your goals aren't tight, you're going to eat a lot of money, and you are going to have a lot of people mad at you because it's not just the price of the asset, and the implementation, the change management aspect, and when you all of a sudden piss off everybody in your firm because you decided that you needed technology before process, you end up really having a problem. I'm sure Michael will be touching on that in a little bit. Um, but we're doing all that. We're using our tools to really replicate our success. What works, what doesn't, right? Reinforce good practices, build confidence in the budgeting practice, really be able to say, and I say this all the time, I'm managing my firm 3 months, 6 months, 12 months ahead of time, right? We're setting reasonable goals and we have a history of achieving them, right? That is what we're trying to do here with this budgeting process. It's about not relying on, oh, how we do last month, and that's going to guide our decisions. It's how are we doing? How do we think we're going to be doing in 3 months? What do we need to change to make it be the way that we want to be? And how does that then relate to the next 12 months or the next 18 months that we're really looking at to try to impact as part of our strategic plan? So that's how you need to look at this and replicating the success and addressing the variances that you see, right? Underperformance. Well, underperformance is either lost profits or it's going to be low cash flow. I've got to get in there. I got to know that ahead of time. Overperformance, how do we redo it? Increase profits. Great. I love that. Why did it happen? How do we do more of it? Do we need to spread it to the other parts of the firm? And as a partner, your next question is, okay, how are we going to split those profits? Who's going to get them? What's it going to mean? Because all your partners have tax planning. So if you're too far off on this, on your budget or your plan, they're going to have a miserable time with their CPAs and getting the information that they need to pay their own taxes, which newsflash is their biggest expense. And we all but ignore it, or many firms all but ignore it. We do not. um, okay, just some quick kind of pitfalls, best practices. Um, this is a bit of a recap. If you're starting too late, it's going to bite you. Your vague assumptions do not allow for a learning loop. Misaligned categories, well, they will destroy a budget and waste everybody's effort and cause so much frustration. And then not, ignoring volatility and external factors, not harnessing them, isolating them, and being able to manage them in a way where you're learning how to get better at that process. What to do is build in those feedback loops. You really have to be learning. Your budget is a tool, it's expectations, it's something to compare to. You should be comparing to those expectations and analyzing them monthly, quarterly, every 6 months. You might get in and adjust your budget, right? You do a mid-year review and adjust it. Why? Because, well, we hired 6 people. Our budget is off. Okay, well, maybe we do adjust, maybe we don't adjust. That's really just going to depend on what 6 people means to the firm. Is it, if it's a 300 attorney firm, okay, maybe we don't adjust. Maybe we just let that roll because we have a budget and we want to know our total variances against our initial plan. Or, hey, we're trying to get a projection down for the end of the year. Let's adjust it to actual after 6, 7 months and let's ride home, some really reliable information as we get to the end of the year, because we've got to communicate taxes, we've got to communicate compensation. So how you're using these things will depend on how you apply these best practices. But in general, you just have to kind of keep control over it, keep it measurable, be conservative in your assumptions so that you aren't off in an unexpected fashion, one way or the other. And again, treat your budget as a strategic tool. That means you constantly have to be thinking about it. It's not just, hey, in December, how do we do against the budget, which is essentially, in many cases when that's the process is you just taken last year's numbers and copy paste them into the budget. And that's what we want to do this year. That's not a good budgeting practice, and that's not what drives the best performance that you can get out of your firm. Thank you, everybody, for allowing me to present and listening. And feel free to ask any questions either now or throughout the rest of. Not that I want to interrupt Mike's part of the presentation, but go ahead and make this dynamic. And if you do have any questions, feel free to reach out at a later time.
Thank you so much, Derek. That was wonderful. And everyone, just to echo that, if you do have any questions, we are doing kind of a formal Q&A at the end of this presentation, but anytime something pops into your head throughout, you can pop it in the chat. You can raise your hand. You can come off mute. Don't be shy. We're fine with it. And Mike doesn't mind being interrupted. He says it all the time. So, in fact, he loves it. So feel free. And on that note, I want to introduce you to Mike for the STS portion of the presentation where we're going to be talking about technology investing. So Mike is our director of business development. And one thing about Mike is he talks to law firms every single day. Mike is super involved in the legal community through his work with the ALA and his attendance at their events. He has a tenured career in the legal industry technology, so he really understands that intersection of your technology and your law firm. So with that, Mike, do you have anything to add?
I don't. I appreciate the introduction uh, and the time today. So I'm very happy with you didn't overset some expectations on my introduction. So I appreciate that. Um, Derek covered quite a bit, and Derek, thank you for sharing your thoughts today. Really appreciate that. Um, a lot of what, or a good portion of what Derek said transitions into what we're going to cover. And I might have maybe 15 minutes. I do want to open it up for some Q&A at the end. But there was a couple things that I do want to touch on initially before we dive into it. And um, it- this is an exciting time, right? For firms, for most businesses, it's budget season time as we head into the end of the year and Q1. I'm being facetious there. Sometimes this is a painful process. Derek certainly and his team make it quite easier. But what we've seen in the 20 years I've been doing this is, and Derek said, start early. We've seen, as at least from a technology perspective, um, budgets, if they are in existence, which is sometimes a rare case. Um, um, they are driven, or I should say, investments are driven by situations that might become intolerable or compelling events that happen. For example, if you want to change your IT services company, that would be essentially potentially one thing that's a compelling event that needs to change. You might have an understanding of what you were spending with that current IT services company over the course of the last year or two, but what is that impact going to be if you make a change? What type of disruptions is it going to cause? And what is the long-term investment going to be if you do make that switch? But say you get to a level of intolerability and it comes to the point where you need the pain is that high that you need to make that change is not something that essentially is budgeted for next year. It's something that, okay, this is what we want to do. It's a strategic decision that we're going to make. A business case is built, it's presented to the stakeholders, and then a decision is made to move forward with one particular managed services company. And then obviously the budget is set aside for it. Same thing could be said with respect to maybe changing a document management system or changing a financial or practice management system. So more often than not, there's not necessarily a true budget identified on the technology side of the fence. So we'll dig into that a little bit as we go forward. I did want to throw this up here as far as some statistics, which I thought was pretty interesting. And what's really interesting to me is what's missing. As far as the conversations that we're having and the firms we're talking to on a daily basis. One particular I was a little intrigued about, and maybe it's embedded into one of these, but it just happened 2 days ago. But the one thing that hits the top of my mind is there's nothing in here with respect to cybersecurity. And maybe firms aren't investing a lot in securing their environment. Maybe they're going out and getting that cybersecurity insurance policy. Maybe they're investing in some controls in place, but are they truly investing in the right way to protect their business, their sensitive data, and their clients' data as well? The other one was the move to the cloud, serverless environments, modernization, if you will. And the one that I thought was kind of intriguing as well is Windows 10 became end of life just 2 days ago. And I would expect that we know what we were doing with over the course of the last 18 months and the investments they made to transition from Windows 10 to Windows 11 operating system over the course of the last 12 months. I thought that would be a bigger impact here, but I just thought that was pretty interesting. So I wanted to share that as we move forward. Um, Derek kind of touched on a couple of these areas as far as the three S's with making technology investments: sustainable, safe, and suitable. There was some um, topics that Derek covered with regards to, if you have limitations in your technology, go out and better the environment, make those investments to create a solution that's sustainable to drive the needs of the firm. I did think that the fact that, Derek, you do most of your work within Excel, that off the top of my head is a application that is suitable, is safe, and of course is sustainable. So, and pretty much a limited investment over time because it's typically included with your Windows and your Office suite. So, but we'll dig into this a little bit as far as how do we create this? How does a firm create their technology investments that are suitable, safe, and sustainable? And I want
Mike,
to I want to
I would
spend. I'm
I
sorry.
would say, on that, it's, Excel could be, suitable for longer term, but it's certainly something where you can sketch this out, and the Microsoft Suite, where it's like you build the prototype, and that, I think, is the point of Excel, is like, can it do what you need to do? Well, it's got its limitations, and the Microsoft Suite has some tools that enhance those limitations, that may make it a suitable longer term tool. But at least, right? At least you're going through the steps, and that's my point. Is if you're just saying technology is going to be the solution, it's like that may be tough. You don't know if it's suitable. You're kind of just you're jumping to the last step and making an assumption. Excel helps to be the prototype to build it and sketch out exactly what you're trying to get to, so you can better target your investment.
Yeah, I appreciate that. And that term you brought up, that word you brought up a couple times is the assumption side of the fence. And that's what we really want to try to do is how do we create a how do we create an environment, a technology environment that is sustainable, suitable, and safe, where it is, I'm hesitant to say eliminating assumption. There's always going to be some level of assumption, but reducing or mitigating that assumption, risk, uncertainty, and then creating a level of predictability, not just a predictability in what we're investing in and the budget, but also the predictability in the technology environment and the technology roadmap. So how do we do that? How do we develop that technology roadmap that's aligned to the budget and vision of the firm 12 months, 24 months, 36 months down the road? And it really Derek had mentioned start early. Um, and I think today is too early. October is too early. One thing we see, which is a little bit, kind of concerning at some times, where we would go into a firm, and I think this happens more often than not, where the stakeholders of the firm, the right people, the leadership of the firm, especially on that partnership level, and Derek cited a couple things that partners truly concern themselves with, and from a technology perspective, is do I come into my office every day and is it working? Are we protected? Is everything running smoothly? If it ain't broke, don't fix it type of perception. But we hear more often than I would like to hear is we don't necessarily know what we don't know about our technology environment and where our investments are going. So it's really taking a step back, slowing down to speed up, and really get a clear picture on what is our current technology environment look like today? What technology did we invest in over the course of the last 36 months, the last 3 years? And did those investments get us to where we wanted to be today? And if the answer is yes, that's great. That's wonderful. It seems like those investments and that plan worked out. The next question, and these are some of the tougher questions to talk to the stakeholders about, is Where do you want to be? Where does the firm want to grow to? And what are our goals and ambitions for the next 12 months, 24 months, and 36 months? And then it's really developing that roadmap, that technology roadmap that's aligned to that. Now, with technology, it could be challenging, right? Technology is quickly evolving. It's always consistently evolving. What you invest in today, not literally, but could change tomorrow. The other components is obviously who the business wants to be, but what are your clients driving you to be? What are those needs? And what are the investments we have to make as a firm today from a technology perspective that's going to accommodate the needs of said clients or new clients? That kind of gets into the realm of your cybersecurity investments. So do you have the right cybersecurity insurance policy in place? Do you have the right controls in place to get that cybersecurity insurance policy in place? But what new clients or what current clients are having you go through certain assessments to evaluate your security maturity level, and what investments do we need to make potentially to accommodate those drivers? So really getting that clear picture is I think the starting point of where the firm needs to go to look at what types of investments they're going to need to make. Um, Digging a little bit deeper and kind of peeling off the onion, and these are going to get into a little bit of some of the blind spots or some of the areas that are typically missed when firms are trying to identify not only just their current state, but identify what their budget needs to be, is really looking at not only who you're doing business with, but who they are doing business with. So if you're going out and making these investments in technology partners, whether it's a IT provider, a service company, or the application set, who are those folks doing business with? And what I mean by that is really from a security perspective, are the collection of stakeholders truly looking at how secure are the vendors that and business partners that you're doing business with and they're doing business with. So if you're going out and working with a new IT services company or looking to change to a new IT services company, what vendors are they doing business with, and what are those vendors' security maturity level assessments? So there's a third party there's ways for threat actors to get to your law firm through third party backdoors, and those are some gaps and vulnerabilities we like to go through in vetting the procurement process. So the other topic is around implementing, and Derek touched on this a little bit with regards to when you're looking to make a technology change, if you want to upgrade or update or get a tool in where you're going to use effectively, and touch on that in a second. When you make a technology change, going to a new document management system, for example, whatever that infrastructure might be, what is that technology transition going to do? How is it going to impact the firm? And what we mean by that is if you're going to implement a new software, are you implementing and integrating that new software on the correct hardware? Are they going to play together, or are they going to be compatible enough? Same thing goes for when you implement that new application. Is it going to be compatible with the other applications that you are integrating it with? For example, if you're going to be implementing a new document management system tomorrow and you're still on Windows 10 operating system, you might have one compatibility issues, and that might impact budget issues. How much money are we truly investing is because there's the licensing cost, there's the application cost, there could be the hardware cost, but there's also that integration cost. And if we're not going back to current state and really evaluating the details, nobody wants to go back to your partners and say, hey, listen, yeah, it was originally X and now it's 2X because we didn't take the time and the consideration and care to truly vet out the environment. So the last topic to talk about on this slide is how we need to deploy it and how we need to adjust it. And this goes into really around training and adaptability. Because one, also goes to suitability, right? So one, how many, if we make this investment, do we understand and have a clarity on what the adoptability rate is going to be? How many users are actually going to be using the application? And the second component to that is how much of the application are we actually going to be using? I think this is a standard across most businesses that there's a lot of applications that companies use that they're only leveraging 20 to 25% of the actual functionality in a technology or in an application. So we want to make sure that we're getting the best and most return out of that application. So what do we need to fully utilize that application in order to get the best return out of it? Just looking at time here. So just kind of looping this together as far as what drains an investment, and we touched on some of them, and I'll start at the bottom. The lack of attention to detail, really getting that firm understanding, that true clarity on what have we currently spent or invested in over the course of the last 3 years. What did we get out of it? Did we have any things that we missed? Adoptability, for example. Are we using the full investment of the technology? Is our environment stable? Is it suitable? Is it maintainable? Are there gaps within what we're using, what we're trying to leverage? There's that break fix solution where firms might not necessarily want to make an investment in a new technology because there's that perception that it's currently working. So they put a band-aid on it and they try to lengthen the longevity of the application or the technology. And that in turn could potentially cost them more money down the road. And of course, there's the vulnerability and gaps from a security perspective. Are you truly vetting out your current security maturity environment as well as your partners and those that are doing business with you? Derek touched on this quite a bit as far as proactivity and staying ahead of it. And this really is summing things up as far as getting that clarity on your current state, right? Really understanding where our technology is today and what does our technology need to be tomorrow in order to stay in line with the vision and the goals of the firm 12, 24, 36 months down the road. It's trying to eliminate that assumption, trying to negate any type of uncertainty or unknowns and create that level of predictability, not just with the technology strategy, but the overall budget. Um, as far as what's the most important and to prioritize, that's of course going to get flushed out during the assessment process, during to the auditing process, as far as getting an understanding of your current technology clarity. The one thing I'll point out here is might be missed sometimes is really what the level of pain is that the firm is enduring with a technology, a tool, or an application. And also another layer deeper, what is the risk tolerance of said application or said technology um, going down completely? So if you take into consideration your email system and how much heavily you rely on that within the firm, or you take into consideration your document management system and how much you rely on that on a daily basis, if one were to go down, what would the firm be able to tolerate as far as it coming back up? A day, 2 days, no days? That kind of helps prioritize what your risk is and where your tolerance is and where your pain points are. Last thing I'll end here is just protecting your investments. Training, we talked a little bit about that around the adaptability and really understanding and getting some clarity of, are we using the full functionality of the applications that we're invested in? One of the big ones is we harp on is security awareness training. I don't think there's enough of it going around. I think that we think that um, the threat actors are getting more creative and more creative and more creative, and the culprits usually of cyber attacks or ransomware are us as users. We click on something we shouldn't. We download something we shouldn't. We go somewhere that we shouldn't. So being able to not only continuously and consistently train your users on what's important out there from a security perspective, but what's important from an application investment perspective. Continuing to update, upgrade, making sure that your applications and those investments are suitable and sustainable. And Derek touched on this. It's not just a set it and forget it. It's constantly reviewing that roadmap. Is the technology strategy continuing to stay in line with the overall firm strategy? Is the budget in line with what we thought it would be? Are there corrections that we need to make? Having those consistent meetings and being transparent with the stakeholders as far as are we continuing to move in the right direction, I believe you're going to create that strategy that you need from a budgetary and an IT investment perspective.